613 at the moment. So let's get right to the floor show and translate all of this for us. Joining me now, Great Hill Capital Chairman Tom Hayes and Carnivore Trading founder Dutch Masters. Tom, okay. Tell me exactly what this should really mean to our investor viewers, because to me, there wasn't that much of a surprise in anything here, yet the market seemed to be a little confused as to how to absorb it all.
Yeah, I think you're spot on here, Liz. This is going to be another case of the last 2 days' weakness, sell the rumor, buy the news. This was telegraphed at the last press conference with Jay Powell. He said that balance sheet roll-off could begin as early as May. We got confirmation of that today. We're seeing Fed funds futures showing a 78.8% chance of a 50 basis point hike in May. So this is known. And to put it in perspective, the 10-year yield touched 2.63 today. The peak in October 2018 was 325, and the peak in January 2014 was 303. The bad news is the 210 spread inverted this week, so we're likely going to get a shallow recession mid to late next year. The good news is the market can push a lot higher in the meantime. Since 1900, there have been 28 inversions. 22 led to a recession that took place 22 months after inversion. And if you look at the last 4 inversions, the market rose for another 17 months, on average 28.8%. So we think there are things to do here in the short term.
Dutch, I agree. I don't sit here and worry too much about a recession when you look at the current data. However, we're kind of seeing a meld between tighter monetary conditions, the situation in Ukraine and Russia. They are big exporters of all kinds of commodities, so prices are continuing to rise, although we're going to get to oil prices dropping exponentially in just a minute. But Dutch, what do you think is the best way to proceed as an investor?
Well, what we did is we went short the Qs yesterday. We went short again more of it this morning. We don't see how, with the 10-year yield accelerating, the rate of change is actually accelerating on the yield to the upside. And we see that as a real problem for long duration stocks. So the tech stocks we got short on. We like, about 3 days ago, Russia came out and said that they were going to stop exporting to anybody who's an enemy. And if you haven't been living under a rock, you know that we're the enemy, and so is Europe.
Yeah, everybody except China.
Yeah, so we're basically going to not have some vital inputs to production and food. So we like the agricultural stocks, the food stocks. So we went long those. This rate increase, it's unsustainable. And really what we're seeing is, when you take a country that's the breadbasket and the gas station and the rare earth mineral mining center of the Eastern Hemisphere off the market, you're not going to solve the inflation problem. And no rate increases by the Fed, by the way, is going to solve that either.
Why did you short the Q? Why did you sell the Q, the QQQs? This, of course, is the NASDAQ 100, best of the best in mostly tech. It's about down 1.6%. But are you saying that growth is going to get killed by value?
I'm not saying that growth's going to be outdone by value. We're a sector picker, and really what we find, I think the thing that carnivore trading's best at is finding the sector that's going to move next. And so we like the food and the agriculture sector. We were early in the marine shipping and the fertilizer sector last year and the year before. So we've had some really, really good runs even in down markets. And so we just don't like how you cannot see rates increase at this rate of change and have the long duration stocks continue to move up. We had a huge rip up here over the last couple of weeks, and we just felt that it might just be time for a pause or somewhat of a retracement.
Okay, we're looking at the Dow right now. Tom, we're down 106 points, low of the session, a loss of 364. But remember, yesterday we lost 280 points. So it's been a rough couple of days here. Today, Patrick Harker of the Philly Fed said this volatile combination of generous fiscal policy, that, of course, were all of the checks that the government wrote during the COVID pandemic, supply chain disruptions, and then only third did he mention accommodative monetary policy have, quote, pushed inflation higher. Man, they just, do they pretend that they kept saying this thing was going to be temporary and it is now in its 15th, 16th month with these high prices?
Yeah, no question about it. I mean, the problem is monetary policy can't create more oil. It can't create a negotiated settlement between Russia and the Ukraine. It can't create an Iran nuclear deal between the U.S. and Iran. So a lot of these things are episodic, but it is persistent. And there's no question about it. We're seeing some green shoots with the port in Los Angeles easing up and the shift from spending on goods to spending on services. We're going to get revenge travel this summer. We know suitcases and swimsuits are big sellers at Target. But we want to be in sectors that are not correlated to GDP growth, because we had 6% last year. We're probably only going to have 3.5 to 3.8% GDP growth this year. So we're focused on biotech because it has a very low correlation to GDP growth, and we are moving into a slightly slowing environment.
Great to have you both. Tom, Dutch, welcome. Great to have you. I do just want